If you're approaching retirement, you might be wondering, is my current investment strategy going to hold up for decades, or do I need to change anything? Now, Mike and Jessica, real prospects, had the same exact question. Now, they'd saved over $5 million, had hugely successful careers, and they were eager to retire early, yet they started to question whether the investments that got them here are the same investments that will help them be successful over the next 30 years. So today I'll show you how we help them restructure their portfolio to avoid some of the major risks to their retirement and how you can do the same. So let's meet Mike and Jessica, not real names, of course. They're in their late 50s, and the reason they're aiming for early retirement is pretty simple. They've really felt like life raced by, and they want to start to enjoy the next phase of this health and energy they have before naturally things start to decline. And the way their $5 million nest egg is spread out is about $3.1 million in a brokerage account, about $280,000 in Mike's Roth, $145,000 in Jessica's Roth, and then Mike and Jessica have $600K in Mike's IRA and $740,000 in Jessica's 401k. And then they also have about $80,000 in cash in the bank. Now, Mike and Jessica had spent decades investing for growth, and like many people that get to this point, they're starting to feel a bit of, pride, excitement, but also a little bit of anxiety trying to understand how to make the most of what they work so hard for. But we need to talk about the first essential risk here. But in order to understand how to start thinking about changes to your portfolio once you get to retirement, we need to first start by taking a look at two different investors. Investor A retires in 1965 and has an impressive 9.3% annual return over the retirement, whereas Investor B retires in 1950, a different market regime, and earns just 7.2% annually. I say just because that's a full 2% lower than Investor A, but they both have the same stock and bond mix. So who ends up with more money in the end? The investor with higher returns or the one with lower returns? And I'm sorry because this is a trick question, but it's not just about how much you earn, it's when you earn those returns. As you can see by Investor B, even though they had lower returns, they were better off. And today we'll focus on building a portfolio to help combat this, the sequence of returns risk, and how it relates to Mike and Jessica. So knowing about this risk, we turn to Mike and Jessica's actual portfolio structure. And to start off, I want to talk through just a principle that we follow in terms of setting aside 3 to 5 years of living expenses in more stable investments, which will look different for everyone, so that if there's a major downturn, we don't need to sell from stocks at a loss just to cover the day-to-day spending. Of course, that factors in your plan, your tolerance for risk, but the concept remains pretty similar, and that's to protect your short-term needs. Now, since Mike and Jessica plan to spend about $20,000 per month, or roughly $240,000 per year, that essentially translates to keeping somewhere between $750,000 and $50,000 to about $1.2 million in that more stable bucket. But there is a catch, right? What kind of stable assets should they hold? Are they actually using the appropriate types of bonds, or are they setting themselves up for unnecessary risk? So we identified how much of their portfolio should be in those more stable fixed income assets. The next step is to dig into what those actually are today. And here's where Mike and Jessica's situation is pretty common to what I see. If we look at their total portfolio, a big chunk of their bond exposure came from multiple ETFs and mutual funds, but the majority was sitting in this 2025 target date fund. Now, on paper, target date funds can be sort of a set it, forget it solution. They automatically shift more conservative as you get closer to that target year, and this sounds great, but the problem is nobody told this fund that you were retiring early. If the fund becomes too conservative too soon, you could be missing out on growth when your plan still needs this money to be growth focused for the next 30 to 40 years. And another key point is where you hold those bonds. In Mike and Jessica's case, the target date fund lived in a 401k account, which likely they wouldn't touch for many, many years. If they won't be tapping that money soon, does it make sense to park it in an overly conservative allocation? That is obviously something for you to decide. Ideally, I want the conservative investments in the account where I'm going to pull from first. And then there came a little bit of a different type of adjustment, and that is that they owned long-term bonds. Now, one position here had a 30% drawdown in 2022 alone. Now, bonds are supposed to be that buffer when stocks tumble, but if both stocks and long-term bonds drop together, where are you going to pull your cash from? Where are you going to create income from? But if instead they own a shorter term, higher quality bond for retirees, knowing, it's not going to knock your socks off with huge returns. Most bonds rarely do, but they tend to stay steady even when interest rates spike. Now, sometimes bonds are designed to be the boring part of your portfolio, so stocks can do the heavy lifting for growth. But that brings us to the next challenge. And of course, another really pressing issue for Mike and Jessica was how do we handle the stock portion? Now, right now, as you'll see, over 50% of their nest egg was just sitting in 3 tech giants: Amazon, Apple, and Google. And they had very mixed emotions on changing these. There's no denying that these companies are phenomenal. They've performed phenomenally, but they started questioning whether they were putting their future at risk with these 3 stocks dominating their entire portfolio. And if we dug deeper, we also found some overlap here. Not only did they own these 3 stocks outright, but they also have mutual funds and ETFs that were heavily weighted in these same names. In other words, they were double dipping or tripling up on the same handful of companies without quite realizing it. Many people know about the idea of not holding all your eggs in one basket, but what does data talk about? What does the data show when it comes to owning these large stock positions? I do a lot of reading on investment philosophy, retirement planning, and one article that stuck out to me recently basically looked at the top 10 largest stocks in the S&P 500 at the turn of the century, names you've heard of: Microsoft, Cisco, ExxonMobil, Intel, IBM. And if we look at the turn of the century from January 2000 to September 2023, a simple Vanguard 500 index returned 6.5% per year, but those top 10 stocks averaged just 3.3%. So not only did owning the largest stocks mean you would have underperformed the broader index, but you have also would have been taking a much higher concentration risk, which could be a double whammy for retirees because they'd be spending that money down. Because if done properly, diversification of risk is actually investors' good friend. And if done properly, you reduce the volatility of a portfolio without reducing its risk adjusted expected return. And what do I exactly mean by that? And what is a real example of how this plays in part a portfolio like Mike and Jessica? A diversified portfolio doesn't just mean multiple companies, but also uncorrelated assets, assets that perform differently at different times. So basically there's likely one part of the portfolio that you're not always happy with at all times, and that might look like owning US markets, international markets, emerging markets, real estate, commodities. And I love this chart here by Vanguard, basically going back to 2012, showing that there really is no discernible difference in the patterns of returns depending on what part of the market you're invested in. You don't want to be losing too often or at the worst possible time, especially when you're relying on investments to generate steady retirement income. But we aren't done quite yet, because we need to talk about the final stage of looking at a retirement portfolio, a problem that often leads to people to a lot of analysis paralysis. Now, I'd say that Mike and Jessica have done a great job growing their nest egg to $5 million, but again, the huge portion of that growth was due to the 50% stock exposure that sits in those 3 big names. Now, we can easily adjust their retirement accounts without any sort of tax problems, but there's a challenge when the portfolio, a huge chunk of it, is sitting in a taxable brokerage account with large capital gains. Of course, if we just sold everything tomorrow, they'd face massive capital gains, and for the most part, that's not always ideal. Now, many of you might be in a similar situation. Maybe you inherited a single stock that just soared, or your compensation was loaded with RSUs over time. Either way, once you're in retirement and relying on your investments for income, you have to decide, do I keep rolling the dice on a few winners? Do I keep kicking the can down the road and let the tax tail wag the dog? Or do I need to start spreading out some risk and maybe factoring in some smart tax planning? And when I think about a big decision like this, there's usually 3 angles I consider when deciding how to adjust these large positions. The first one, of course, is the investment perspective, which we talked quite a bit about. Again, if 1 or 2 positions crater your retirement, you can't just wait it out like you did in the accumulation phase. Number 2 is the tax perspective, which we'll focus on in a second here. But again, people often fear the capital gains hits from a long-held winner, but a major drop in that concentrated position can wipe out far more than just your tax bill. Lastly, and this is something that I don't think most people talk about, is the emotional perspective. It's easy to say I'll handle the volatility until you watch your net worth, yo-yo by 6 figures in a single week in retirement. Sometimes that peace of mind alone is worth trimming a concentrated position. So how are we actually going to adjust this? Clearly, we knew we didn't want to be concentrated. We knew it would be difficult emotionally, but how do we think about this from a tax perspective? Because again, we could dump it all at once, but that might trigger a hefty tax bill. So here's the steps that we went through. And the first one is to identify the holding cost basis for each position, right? Figuring out which shares have the largest capital gains, which ones are long-term versus short-terms, because we know that selling those long-term gains assets first can reduce immediate tax hit versus selling the shorter term gains. Number two, we can spread the sales over multiple years because they're retiring early. Mike and Jessica may have some lower income years before Social Security kicks in, and that's usually an ideal window to carefully sell shares, filling up each tax bracket instead of just jumping straight to the top. And then thirdly is coordinating those with Roth conversions. Now, Roth conversions can also raise taxable income, but by spacing out big stock sales and conversions, perhaps in different calendar years, you avoid piling everything on top of each other. And the last thing is leaving room for charitable planning. Since Mike and Jessica are charitably inclined, we arranged for them to donate appreciated shares directly to a donor advised fund, thus eliminating the capital gains on the positions while supporting all the causes that they care about. Now, going through with this plan means that even Apple, Amazon, or Google keep surging, they'll still participate in the upside through diversified funds, but they'll also dodge the worst case scenarios of holding too much in one basket, and over time transferring a portion of their big tech into broadly diversified funds still does set them up for growth, but also keeping risk very manageable. And the last thing I'll say, it's easy to feel really attached to a stock, especially when it's made you a lot of money. But once you're in retirement, the stakes get quite high. If a single position drops 50 or 70%, could you stomach that stress while you're trying to enjoy the life that you spent decades building? Now, if the answer is no, then it's time to plan a measured tax-savvy strategy to start thinking about reducing that concentration. And for Mike and Jessica, they decided that the peace of mind was worth it. They believed in the principles. They still hold these terrific companies. Now, their goal was balance and not elimination, and that puts them in a strong position for the next 30 years, giving them the growth potential while also managing volatility. Now, maybe you find yourself in a similar spot. You've worked hard, built up a large positions in a few stocks, or maybe you have big capital gains in a concentrated fund. At this point, it's not about how high your returns can go. It's about how well you can start to protect your spending power and manage taxes so that you can sleep well at night, knowing that you are set up for retirement. And if you're wondering how to build a retirement tax strategy, especially when it comes to Roth conversions, my next video walks you through the key steps to avoid some unexpected tax hits. So click or tap here to watch that now. And when you jump that video, I'll see you right over there. Thanks for watching, and I'll catch you on the next one.